Hey everyone, welcome back. Ready to unlock some serious retirement potential.
Let's do it.
Today, we're diving deep into Roth IRAs, those retirement accounts everyone seems to be talking about.
Yeah, they can be pretty powerful.
We've got some great info from a text all about Roth IRA investing, so we're going to break it all down for you.
More than just the basics, though, right?
Right. We're talking the good, the bad, and everything in between, so you can figure out if a Roth IRA is right for your retirement plan.
All right, let's kick things off.
Okay, so let's talk about the big one, tax-free growth. I mean, who doesn't love the sound of that? But how does it actually work in a Roth IRA?
So you make contributions with after-tax dollars.
Meaning you've already paid taxes on that money.
Exactly. But all the earnings inside the Roth IRA, they grow, and then you can withdraw them in retirement completely tax-free.
Wait, so you're saying you pay taxes up front, but then all those earnings are basically tax sheltered?
Yep, you got it. As long as you follow the rules, of course.
There are always rules.
Oh.
Okay, so it's kind of like a long-term investment where the government gives you a break on taxes later on.
That's one way to look at it. It's like planting a seed that grows into a beautiful tax-free retirement tree.
I love that analogy.
And that's where the magic of compounding really kicks in.
Ah, compounding. Everyone's favorite financial buzzword.
But it's buzzworthy for a reason. Think about it. Even small amounts invested early can snowball over decades, especially when you factor in tax-free growth.
Okay, so let's get specific. Paint me a picture.
Say you invest $500 a month, right?
Okay, I can picture that.
And you do that for 30 years. In a taxable account, you're paying taxes on those earnings year after year.
Yeah, that eats into your profits.
But with a Roth IRA, those earnings are compounding tax-free, which could potentially mean a much, much larger nest egg down the road.
So you're saying that even though I might pay a bit more in taxes now?
Because you're using after-tax dollars to contribute.
Right. The long-term benefits could outweigh that initial cost?
Potentially, yeah.
Yeah.
Especially if you start early and invest consistently.
Makes sense. But hold on, there are always some catches, right?
Well, you always got to play by the rules.
Speaking of rules, what about contribution limits? How much can I actually put into a Roth IRA each year?
That's a great question. So as of 2021, the limit was $6,000 for folks under 50.
Okay, not bad.
But for those 50 and older, you get a little bonus, a catch-up contribution of $7,000.
Oh, nice. A little boost as you get closer to retirement.
Exactly. But remember, those numbers can change, so always check the latest IRS guidelines.
Right. Good reminder. It's always good to stay up to date on those things. Now, this is something I've always been a little fuzzy on.
What is it?
Income limits.
Yeah.
Not everyone can just open a Roth IRA and start contributing, right?
That's right. There are income limits for direct contributions.
So it's not a free-for-all.
Nope.
No.
In 2021, if you were single and making over $140,000,
Uh-oh.
or filing jointly, making over $208,000, you couldn't contribute directly to a Roth IRA.
So if you're a high earner, are you just out of luck? No Roth IRA for you.
Hold on. Don't despair just yet. There's a workaround. The backdoor Roth IRA.
The back door, huh? Sounds kind of sneaky.
A little bit. It can be a smart strategy for higher earners who think they'll be in a lower tax bracket during retirement.
Okay, I'm intrigued. How does this backdoor thing work?
Essentially, you contribute to a traditional IRA first.
Which doesn't have those same income limits.
Right. And then you convert those funds into a Roth IRA.
So it's like a two-step process to get around those income restrictions.
Oh,
Clever.
it can be a good option for some people, but there's a catch. When you convert,
Yeah.
you'll owe taxes on that amount you convert in the year you do it.
Ah, so there's no free lunch.
Not exactly. It's a complex decision. You got to factor in your current income, your future tax bracket, all sorts of things.
Definitely sounds like something to discuss with a financial advisor before jumping in.
Absolutely.
Okay, so let's say I've got my Roth IRA set up and I'm ready to start investing. What are my options? Can I just put cash in there?
Cash, not quite.
So what, like stocks and bonds and all that stuff?
You got it. You can choose from a variety of investments like stocks, bonds, mutual funds, ETFs.
Okay, I'm starting to get a little lost in the financial jargon here. Can you break that down a bit?
Sure. Think of ETFs and mutual funds like baskets of different stocks or bonds.
Like a diversified investment.
Exactly. It helps you spread your risk, so you're not putting all your eggs in one basket.
Because if that one basket falls...
Exactly. You lose all your eggs. Diversifying helps cushion the blow if one investment isn't doing so well.
Makes sense. So you're basically building your own Roth IRA dream team of investments based on your risk tolerance and your financial goals.
That's the idea.
All right, so let's fast forward now. It's retirement time. I'm finally ready to enjoy the fruits of my labor, and all those tax-free withdrawals must feel pretty good.
It can be pretty sweet, especially if you've been contributing consistently for decades.
And I imagine those tax-free withdrawals are especially helpful if you're in a higher tax bracket during retirement.
They definitely can be. But you gotta remember, it's all a bet on the future. Tax rates could change, so it's not a guaranteed slam dunk.
That's true. Nothing is ever set in stone when it comes to taxes. But wait, there's another perk to Roth IRAs, right? No required minimum distributions, or RMDs for short, during your lifetime.
You got it.
Explain this to me like I'm 5.
Okay, so with traditional IRAs, the government says you gotta start taking withdrawals at a certain age.
Ah, yeah, I've heard of those.
But with a Roth IRA, you get to decide when to take the money out.
So my money can potentially keep growing tax-free for longer.
Exactly. And it can make estate planning a bit easier, too, since you have more control over when and how much you withdraw.
So you can potentially pass on more wealth to your beneficiaries.
Right, though the rules for inheriting a Roth IRA can get a little complicated, so professional advice is always a good idea.
Good point. Now, we've covered a lot of ground here. Tax-free growth, contribution limits, income limits, even those backdoor Roth IRAs and conversions. Is there anything else our listeners should consider?
One last thing. What if you've already got money in a traditional IRA or a 401k?
A lot of people do.
You might want to think about converting those funds to a Roth IRA.
But didn't we talk about conversions earlier? Doesn't that trigger a big tax bill?
It can, yeah. You'll have to pay taxes on the amount you convert in that year.
So, not a decision to be made lightly.
Not at all. It's best to get some expert guidance before making that kind of move.
So, it sounds like Roth IRAs can be a really powerful tool for retirement planning.
They really can.
But it's important to understand all the ins and outs, right?
Absolutely. They're not a one-size-fits-all solution.
Your individual circumstances, your financial goals, your risk tolerance, all of that plays a role in deciding if a Roth IRA is right for you.
Couldn't have said it better myself.
So here's something for everyone listening to ponder. How could incorporating a Roth IRA, or even converting existing retirement funds, change your retirement outlook? It might be time to explore those possibilities further with a financial advisor. Thanks for joining us for this deep dive into Roth IRAs.
Thanks for having me.
Until next time, happy investing.